Crude oil could be on the verge of a big comeback. The commodity kicking off the new year in the green, up about 3% so far this week, coming off its first yearly drop since 2015. One of our next guests says it just bounced off a critical level. I'm joined by Matt Maley of Miller Tabak, Michael Bapis of Rockefeller Capital Management. So, Matt, tell us, what was that critical level and why does it matter?
Well, it got down to the 42.50 to 53 level to be exact. Well, 42 and a half,
42,
basically.
Yeah.
And yeah, sorry, 42 and a half at 42.50. And that was the low it saw back 18 months ago in June of 2017. Now, after that, we saw that low. The crude oil rallied 80% off those lows. And now it came back down. It got right exactly to that level on Christmas Eve and has bounced almost 10% since then. Now, we're not out of the woods yet. We need to see some more upside follow through. And what we want to see is get it above $50. Now, that's not just a round number. Remember, back in November, December, it bounced off that level a dozen times before it broke down. So that old support becomes new resistance. If we can break above that and hold, that'll show that we got a real nice double bottom, much like we got in 2016, and should give us a nice upside rally. It may not be 80%, but it should be a good rally.
Now, just quickly looking at that chart, the last time it hit that exact price, it did seem like the chart kind of appeared different, right? I mean, it wasn't exactly as far below its trend and all the rest. No,
yeah, exactly. And you get, you know, again, you have other things like its MACD chart and certain long-term MACD chart. It's making a higher low, so that's positive too. Yeah. So we got to be careful, because if it rolls and breaks below that double bottom low, we got big problems. But I do think that double bottoms are one of the best formations you want to see when you're making something of concrete substance.
Sure. And Michael, so do you think this potential comeback is something worth playing? And if so, how would you do it?
Yeah, let's go back to Econ 101. It's a supply and demand issue. You saw OPEC cut production by the most in 2 years, and it's starting to work this month. The U.S. oil production also was much lower than people expected. And obviously, you see the technicals bouncing into the positive scenario. And one name in the space, EOG, they've outperformed the commodity between 15 and 20% over the past 12 to 18 months. And we think they'll continue to outperform. We believe oil's going to roar higher here just on a simple supply and demand issue.
All right, would be a big switch from last year. Guys, thanks very much, Michael and Matt. For more Trading Nation, head to our website or follow us on Twitter @TradingNation.
Volatile markets are a good time for longer-term investors to review their asset allocation plans on their core holdings. If you're overly concentrated in a specific stock or sector, volatility will probably do more damage to your portfolio. Diversified accounts generally fare far better when volatility increases.